Hello guys, welcome to our FX Pesa webinar. Today I'll be taking you through the intermediate session dealing with price action, Forex charts, support and resistance, and candlestick patterns. Price action and candlestick patterns. Price action refers to a movement of a security's price which is plotted over time. Many short-term traders rely on price action in relation to the formations and trends to make trading decisions. Price action usually forms the basis for all technical analysis for financial assets. What is technical analysis, you may ask? This is the study of historical prices to anticipate the future movement of prices using the charts as a basic tool. The origin of technical analysis is derived from the Charles Dow theory developed in the 1900s. As a trader, you study past data to help you spot trends and patterns which could help you find some great trading opportunities. Types of Forex charts. 1. We have the line chart. A simple line chart draws a line from one closing price to the next closing price. When joined together with a line, we can see the general price movement of a currency pair over a period of time as shown on the chart below. 2. OHLC chart. A bar chart is a little more complex. It shows the opening and closing prices as well as the highs and the lows. The bottom of the vertical bar indicates the lowest traded price for that time period, while the top of the bar indicates the highest price the market has reached. The horizontal hash on the left side of the bar is the opening price, and the right side horizontal hash is usually the closing price. Candlestick chart. Candlestick charts show the same price information as an OHLC bar chart, but in a graphic format. Candlestick bars still indicate the high to low range with a vertical line, and in a candlestick charting, the larger block or body in the middle indicates the range between opening and closing prices. The thin line shows the lowest and the highest prices reached within that time range. Candlestick anatomy. We have two types of candlesticks. We have a bullish candle and a bearish candle. On a bullish candle, the opening price is always lower than the closing price, whereas on a bearish candle, the opening price is always higher than the closing price. Every candlestick has a line which is known as wicks. The upper wick usually represents the highest price reached for that session, and the lower wick represents the lowest price reached for that session too. Support and resistance. Support and resistance is one of the most widely used concepts in Forex trading. When the Forex market goes up and then pulls back, the highest point reached before it pulled back is known as the resistance point. And as the market continues down again, the lowest point reached before it changed to an uptrend is usually known as the support. This way, resistance and support levels are continually formed as the Forex market oscillates over time. One important thing that you should note is that the support and resistance levels are not exact numbers. As seen on the chart below, we have different support levels and we have different resistance levels. On the lower side, you have the support levels, and on the higher side, we have the resistance levels. Points to remember. 1. When the price passes through the resistance could potentially become support. The more often price tests a level of resistance or support without breaking it, the stronger the area of resistance or support is. And when a support or resistance level breaks, the strength of the follow-through move depends on how strongly the broken support or resistance had been holding. As seen on this chart, we have different types of resistance and support levels. We have minor resistance and we have minor support. What this means is, when a resistance level is tested so many times, that makes it a major resistance. And when a support level has been tested so many times, it makes it a strong support, as seen on the chart. Trend lines. This is a line connecting two or more points along the same level. The essence of a trend line is to spot the best point in which to buy trades in an uptrend. On a downtrend, you are able to enter optimal sell trades when the price approaches the trend line. How to draw a trend line correctly? 1. Focus only on the major swing points. 2. Connect at least 2 major swing points. 3. Adjust it so that you can get the most number of touches on the chart. As you can see on this chart, the purple line represents an uptrend. Reason being, it has connected 3 points, hence making it a valid trend line. On this other chart, the purple line shows a downtrend. This trend line is valid because it has connected 4 points as shown on the chart. We have 3 types of trends. We have an uptrend which has higher lows, we have a downtrend which has lower highs, and we have a sideways trend which is usually ranging. It takes at least 2 tops or bottoms to draw a valid trend line, but it takes 3 to confirm a trend line. Trend lines become stronger the more times they are tested. The steeper the trend line you draw, the less reliable it is going to be. As seen on this chart, we have the uptrend, downtrend, and sideways trend clearly illustrated. For the blue lines, they show uptrends which have higher lows. For the red line, shows a downtrend which have lower highs. And for the sideways trend, as seen, it's ranging in between. The lows are neither high nor low. Channels. This is a chart pattern formed from 2 parallel trend lines. Channels are just another tool in technical analysis which can be used to determine good places to buy or sell. When the prices hit the lower trend line in an uptrend, this may be used as a buying area. When the prices hit the upper trend line on a downtrend, this may be used as a selling area. As seen on the chart below, we have different types of channels. We have an up channel, we have a down channel, and we have a sideways channel. On the up channel, this indicates an upward trend. On the down channel, it indicates a downward trend. And on the sideways channel, there is no specific trend that is defined at that moment. How to trade support and resistance. We have a number of ways which you can trade support and resistance. And one of them is the bounce. When playing the bounce, we want to turn the odds in our favor by waiting for confirmation that the support or resistance has been held. As illustrated below, when the price bounces off a support level, this can be an indication to enter the market on a buy order. On the other hand, when the price bounces off the resistance level, this can be an indication to place a sell order in the market. The other technique of trading support and resistance is known as the break. Here, you buy or sell whenever the price convincingly passes through a support or resistance zone. As illustrated below, when the price passes the support level, this can be an indication to enter the market on a sell order. Candlestick patterns. A candlestick is a type of price chart that displays the high, low, open and closing prices of a security for a specific period. Candlestick charts are thought to have been developed in the 18th century by a Japanese rice trader known as Munehisa Homa between the years of 1724 to 1803. They were later introduced to the Western world by Steve Nissen in his book Japanese Candlestick Charting Techniques. Psychology of candlestick charts. As seen below, the long red candlesticks indicate the bears are dominating the market and sellers exceed buyers. In this illustration, the short candlesticks indicate that neither the bulls nor the bears are in control and there is very tight trading. And in this illustration, the long lower shadows indicate that the number of sellers were higher, but the buyers came back to overcome the selling pressure. Whereas in this illustration, the long upper shadows indicate that the number of buyers were higher initially, but the sellers were able to come back. And in this illustration, the upper and the lower shadows on the same candlestick indicates that both buyers and the sellers had equal control in the market. And this brings us to the end of our webinar. Thank you for your audience.